Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
This is Todd Taskey with the Second Bite Podcast. I am very excited today. We have a special guest, Jamie Elias, who's a senior partner at Trivest Capital in Miami. Jamie, super happy to have you on what has turned out to be Blue Shirt Friday. Very good to have you.
Yeah, thank you, Todd. Thank you. Happy to join you.
Yeah, this is going to be a great episode. Before we jump in, I just want to quickly say thanks to our sponsor, the good folks at E. Cohen. E. Cohen is a firm actually right here in the Washington, D.C. area. They are constantly listed on best regional CPA firms and advisory firms. ecohen.com is where you can find out more information on them. They have helped me many times prepare clients' financials so they look absolutely their best when they are talking to a buyer, an investor, or somebody like Jamie. So ecohen.com will thank the good people there. And Jamie, nice. I know how busy you are. It's great that you took time to be with us today.
Great. Thank you.
Hey, Jamie, I, like a lot of people in the private equity world, am familiar with Trivest. But for listeners perhaps that are not, could you give us a quick introduction into Tribest?
Sure. Tribest is the oldest private investment firm or private equity firm in the southeastern United States by a wide margin, and actually one of the oldest and most established private equity firms in the country. We were founded in 1981, and today we focus exclusively on founder and family-owned businesses throughout North America, the U.S., Canada. More recently, we have been completing transactions in Central and South America, but by and large, the vast majority of our portfolio company investments, to which we have 38 companies now in all sectors of the economy. We are headquartered in Miami, Florida, but we have regional offices around the country: Los Angeles, Charlotte, Chicago, Philadelphia, Toronto, and on and on. We have close to 60 professionals in the firm across the investment team, portfolio support team, business development, marketing, you name it. And we've really established or carved out a niche for us as the go-to firm when founder and family-owned businesses are thinking of what's next in their life and pursuing a transaction with a firm like ourselves.
And you're not the only guys that think you're pretty good at what you do. Grady Campbell, Inc. Magazine, and others, I think almost every year has you on the list of private equity firms that are friendly to founder and family-owned businesses.
Yeah, I think one of the dirty little secrets in private equity, the reason private equity, I go to every business meeting with a founder with a baseline assumption that, and I open the meeting with, let's get something off the table. And they say, what's that? And I say, I'm going to assume you have a negative impression of what I do for a living. And I always get the laugh like, Todd, you're laughing now, or a chuckle or a smirk. And I say, the first dozen years I was at Trivest, I would try to tell that business owner why their impression is incorrect, why it's not fair. And now I just say, I acknowledge that has set in, and I joke about if you ever read a positive article about private equity, send it to me for my file of one. But for the last dozen years, we've tried to accentuate or explain to business owners why we're different and how we're different. The number one reason private equity gets a bad reputation in my mind, and I've been at Trivest for 23 years, is what I like to call the hosing at the closing, or the retrade, which means I love your business. It's worth $25 million. You sign a letter of intent. And sure enough, a week from closing, the dreaded phone call comes to the business owner, their lawyer, their accountant, their advisor, which is the private equity firm would like to talk about their due diligence findings. And I tell people, if you ever get a call from a private equity firm about to buy your business and they open with, we want to kind of review our diligence findings, the next word out of their mouth is the price is coming down. And so we have a no retrade policy at Trivest, which means we'll do more work to get to a signed letter of intent. But once we sign that letter of intent, we're closing on the terms and the valuation contained in that letter of intent. And so these are examples, and the proof is in the pudding. We have, I think, 43 founders that did a transaction with us and felt good about the experience and good about our interactions, that they turned around and became investors in Tribest. And there's just not a lot of private equity firms that can make that statistic.
Yeah, there's a few things that are interesting. So first of all, I hope you will continue to share the quote unquote dirty little secrets, because that's what we're listening for, number one. Number two, you guys have done, I know, over 300 transactions. So you've been very successful at it. Here's how I'd like to break down our conversation today. First of all, I want to talk about how the machine that's Trivest, because you guys do a really good job of identifying both companies and CEOs that you would like to back. But you also, there's private equity, and private equity is, we're going to make an investment, we're going to buy the company or take a control in the company. And you guys do that. The part that we're going to spend a lot of time on is you have a non-control fund where the founder can take a lot of money off the table and still maintain control of the business. And when I tell that to prospects and clients, they're like, yeah, I'm not sure that that's really the case. So that's very unique. I want to talk about that. But then you also have your discovery fund. And the discovery fund focuses on $1 to $4 million businesses, not just to tuck into something that you already have, but to be a platform. And nobody else out there that I'm aware of does that. So that's how I'd like to break down.
Those are great. That really covers the gamut of who we are. Again, if you think of Tribest, the halo is founder and family-owned businesses. And for many years, decades, we were like everybody else, which said that our tagline is private equity for founders. But the dirty little secret was there should have been a footnote after that tagline that said, so long as the business owner is willing to sell a controlling stake, and so long as the business has at least 20 million of revenue and $4 million of EBITDA. And we sat around, we have incredible investor demand to invest in Tribest. But we like to stick to our knitting, and what we're good at is investing in a certain size business. So rather than doubling or tripling the size of that, quote, flagship core fund that was actually started in the early 80s, what we did was just simply make extensions. And so the first extension was, what's the problem of taking a minority stake in a well-run founder family-owned business? And then the other extension was, ever since I got to Trivest in 1997, it was that business has to generate $4 million of EBITDA for us to engage. And we said, that's kind of stupid. Why are we doing that? There's great businesses that are just either earlier in their life cycle, or it's just a great business, but it's not at $4 million of EBITDA. So we basically have 3 active fund strategies, but they're all around founder family-owned businesses exclusively. So Trivest Fund 6 is a $630 million vehicle that takes control stakes in, quote, larger founder-owned businesses, $4 million of EBITDA and up. We have Trivest Growth Investment Fund, which we call TGIF, and that takes non-control stakes in well-run founder and family-owned businesses, and I'll talk about that more in a minute. And then more recently, we raised the Trivest Discovery Fund, which is specifically targeting companies with $1 to $4 million of EBITDA. So we really feel like we have the gamut, and whatever a founder wants to do, we have a fund that's appropriate for that founder. Most importantly, once the money goes in, whatever pool of capital it gets invested in, the program to build value, which we call the path to 3X, is the same whether the money comes from Trivest Fund 6, whether it comes from our non-control fund, or whether it comes from the Discovery Fund. It's the same thing. But to go back to your first question about the front end of our business, Trivest's been around since for 40 years. So we've always had we've built a nice brand name, quote unquote, in the market, but you can't just sit back on your brand name. Our motto is go find the transaction or the deal before it finds you. So we have an enormous investment in the front end of our business, which we dub business development. So we have a dozen individuals spread around the country, and they are in their local communities in Southern California, in Chicago, in Philadelphia, in Charlotte, in Toronto, and they interact with the law firms, the accounting firms, the wealth managers, the insurance brokers, and on, and they are constantly staying top of mind. Ryan Parker, who leads our marketing effort, oversees a database of, I think, 18,000 individuals that we're constantly communicating with. And it's not just bring us a deal, bring us a deal. We'll run a sports contest. We have these kind of fun Friday emails. And the whole goal is stay top of mind, get the Trivest brand on the mind of people that interact with business owners.
And that's helpful. It's also, unique in the industry. Again, Ryan, who you mentioned, has done a little bit of work for our listeners. So if you go to trivest.com, TRIVEST.com /second bite, he's going to have information posted on Trivest, some interesting things, I think, and some follow-up and ways to get routed with people at Trivest. Anyone listening can do that through me because there's a lot of folks that are familiar with us, so they can reach out to me and we can do that. Or you can go to trivest.com second bite. So let me ask you this. Just in terms of, so 12 people is a lot, but there's a group like yours will look at how many in a year and then define what look at means and how many entrepreneurs, how many deals, how many CEOs, how many businesses.
We call it a funnel, and Tony Hill and Chris Burton oversee this part of our business. And you would be amazed at the granularity that we get down to by region. We slice the data, and every month we look at it as an entire firm. But the big picture funnel is this year we are on track to, quote, bring in or evaluate 4,000 companies, 4,000 transaction opportunities. Of that 4,000, we will meet with around 800 business owners. And from that 800, we will probably close 40 transactions between platforms and add-ons. Again, for people that aren't familiar with that terminology, a platform to us is a business with size, scale, management depth. And that is, quote, the platform. And then once we invest, to the extent that the founder is interested and there's an opportunity, we will go around many times to the smaller competitors and pick up the phone and say, hey, we've invested in XYZ company. We've identified your business as a, quote, merger candidate. We refer to them as add-on acquisitions. But in 2019 and 2020, if you aggregate those 2 years, we did 85 transactions. So it's roughly one in 100 transactions that comes into the firm we end up closing on. And so that's a very large funnel, 4,000 opportunities. And so you have to efficiently screen those transactions because nothing irritates a business broker, a lawyer, an accountant who takes their time to pick up the phone or send us an email on a deal opportunity and we don't get back to them, right? And so what we're trying to do is efficiently screen and say, is this company or this opportunity highly correlated to previous success? And we developed literally a scorecard that every transaction is evaluated through. It's 12 or 13 quantitative and qualitative measurements, 0 to 5, and it lets us know if something is highly correlated to previous success. And if it's highly correlated, that gets the momentum internally to try to push the opportunity forward.
So you've been one of the questions I really wanted to ask is the I'll call it the characteristics of a winner, whether it's characteristics of the company or the CEO. So you've seen obviously a great data set of this over the years. Is there one or two most important things in the CEO and or in the business that you look for more than any other?
Well, I mean, it's a great question. I tend to get the question of like, where are the bad opportunities? Or Tribest has had enormous success, and tell me about your bad transactions. And this will be instructive on what makes a good transaction. The number one reason over the years that we've had poor performance is that we go into business with bad people or the wrong people. And so it really does start with that interaction you have with the business owner. Can you have a conversation with that person? And just getting a sense of the people and the culture, because I view what we do, we are a specialized private equity firm. Investors 10, 20 years ago would say a specialist private equity firm is one that does healthcare, food and beverage, technology. And I agree that those are specialties. I also think that in a founder family owned business, if Tribest comes in and acts like they're the smartest people in the room with the sharpest elbows, which is the vantage point of a lot of business owners, you can mess up a founder family owned business very, very quickly. And so we don't think that we're going to ever be as smart or as knowledgeable as the business owner. And so, beyond that, is this an industry that has headwinds or tailwinds? We prefer to invest in growing industries. Does the company have good customer diversity? Has the company had historical, growth, or has the business been flat or declining? If the business has been flat, sometimes there's reasons for that, and maybe we can address it. But there's common things, but we are at our core a generalist firm. We have 38 portfolio company investments. And if you looked at the description of those 38, you'd honestly think that we're schizophrenic, because we have everything from consumer to manufacturing to technology to garbage truck rental businesses. It runs the gamut. But when you peel back the onion of a founder and family-owned business, many times the simple deficiencies are they never seem to have enough salespeople, and the finance and accounting departments are typically 3 to 5 years behind where the company currently sits. And those are easy things that we can help with. But you would be surprised at the commonality you see across businesses that have $10 to $100 million of revenue, which I would say is where, we're typically playing.
And is there one thing, and then I want to jump into those two funds, is there one thing in that sweet spot that you work in that CEOs overrate themselves on, or think that the company is stronger at than they really are, that you just know is a blocker to their continued growth and success?
No, I mean, we always ask. We have this thing that we try to implement at our companies called what is your category of one statement? Why do people stand in line at Starbucks for 5 or 7 minutes to buy a $4 cup of coffee when there's another coffee shop that'll give it to you for $1 or $1.50? Why do people stand in line at Chick-fil-A? Why do people go to Amazon, Apple? There's countless examples where these companies are able to establish an emotional connection with their customer such that when the competition starts shoving competing offers in customers' faces, the customer puts their hands over their ears and says, you know what, this is my company. And so how do you bring that down to a $10 or $15 million consumer products company or a services company? It can be done, but it takes time to implement. And the goal is get everybody at the company pitching the same story about what is your unique selling proposition, because the founder and the CEO are typically the best salesmen at the company. But when you go out and then you realize, well, what is the last guy on the sales team saying or doing? Why there's variability is there's variability in the messages people at a company are sending. And so we try to systematize that, just like we've systematized the first meeting, how we describe Trivest to the 800 business owners. They're hearing the same thing, whether it's me or whether it's the first year associate just starting in our firm. It's the same message.
That's great. I want to jump into the two funds because they really are unique from my perspective. I know you run the NonControl fund, the TGIF fund. I want to talk about that in a second. Can you talk about the Discovery Fund? But why are you guys, quote unquote, dipping so low in the EBITDA range to discover funds? And what are the things that you're looking for there?
Yeah, I mean, I think it's born out of literally not pursuing hundreds and hundreds of deal opportunities each year. Meaning, for up until a year and a half ago, if a transaction had less than $4 million of EBITDA, it was a polite and respectful turn down, right? And it just didn't make any sense. And we went back and looked at some of our most successful deals, and sure enough, they all started in that sort of, sometimes we would do a transaction, it was 3.8 million of EBITDA, and we would justify why it's okay, or it's $4.5 million of EBITDA. One of my partners, Forrest Wester, met a plumbing company about 4 years ago in Louisville, Kentucky, called Don Howard Plumbing. It was a great plumbing business in Louisville, Kentucky. And it was, quote, a smaller company, but it had some elements that we knew that we liked. We like essential service businesses, right? When your toilet backs up in the middle of the night, that's not deferred maintenance. Like, you are going to call the plumber the next morning and spend the $400 or $500 to get that fixed. So we started with a business. It was about a $20 million transaction, $25 million transaction. And we brought the full arsenal of Tribest to the table. We completed a dozen add-on acquisitions and took it from a local plumbing business in Louisville, Kentucky, to one that was spread throughout the Southeast and Midwest. And long story short, that $20 million plumbing business 4 years ago was sold about 9 months ago for a little over $1 billion. Wow. And so that's why we pursued the Discovery Fund, because we realized there's great businesses out there that are run by really talented people. And for whatever reason, that business owner is ready to go to the next level, but they realize they need some muscle and horsepower, which we can deliver to them. In the case of Don Howard Plumbing, which became Turnpoint Services, I think there was like 12 or 15 members of the management team, not owners of the business, that became millionaires because we're very big believers in getting equity into the hands of the people that are doing the work day to day. And so there are other stories. That's obviously an extreme, but there are countless stories of these companies that are right on the cusp of being at $4 million of EBITDA that we've grown substantially over the years.
It's great to hear you tell that story. I've got a wall full of entrepreneurs that are 2 million to 3 million or close to either of those numbers, that when they project out, realize that they'll be 4 or 5 million of EBITDA. And if they could get the help you're talking about a little bit earlier, it's very difficult to scale a sales team, and it's no fun. And there's a unique skill set to that. Having the right finances, all the things that you talked about. If we go back to the plumbing, just as an example, That gentleman, I'm sure, sold X percent, a majority percent, right? Because that's what that fund does. And then I would imagine when you sell it for $1 billion of value, his second bite of the apple was
significantly larger than the quote sale of his original business.
When you say significant, we're talking multiples, like 5 times, 10 times more.
Well, I don't remember the exact number because again, I think we bought 70% of Don Howard Plumbing, and that founder reinvested 30%. So he owned 30, we owned 70. But right, when you grow something as large as that deal team at Tribest, along with portfolio support and along with business development, right there, the second bite of the apple is what the founders are playing for, and that sort of dovetailed into. And so that Discovery Fund has gotten off to a very fast start. It's a $225 million pool of capital. We have, I think, 4 or 5 platforms in the company already, and they are pursuing add-on acquisitions on behalf of those companies. It's in, a restoration business, a safety products distributor, a parking lot paving company. If you will, right? All of these kind of niche areas, but there's a lot to be done with those. On the non-control fund, or the growth fund, as we call it, TGIF, that was really born out of frustration for Tribest, which is on the Discovery Fund, we would simply turn it down because it was too small. But there's plenty of companies that are really nice and might be a little bit bigger, $4, $5, $10 million of EBITDA. And the business owner has a company that's growing actually pretty rapidly. And what we found is it's typically binary. When a business owner is ready to sell, they're either ready to sell their business or they're not ready to sell their business. With non-control investing, they're saying, hey, I don't want to sell it all right now, or I don't want to sell the majority now because what's ahead of me, I know is pretty significant. And I feel like I would be leaving too much money on the table if I sold now. Would Tribest consider buying 35 or 40% of my company and, letting me retain economic and operational control? And for 35 years, we said, no, we don't do that because that's what everybody else in private equity did. But we only do founder family-owned businesses. We make people extremely wealthy upon the buyout. And then we rely on that individual to continue to run the business. And you look at, Mark Zuckerberg, you look at Elon Musk, you look at these founders, that they don't need to go to work the next day, but they go to work the next day, right? Because it's less about the money and it's more about punching it in the end zone and building something. And so we've known that for so long doing these founder-owned transactions that just because you hand somebody money doesn't mean that they're not motivated to go to work after a transaction. And so we raised the first fund in 2016. It was a $225 million vehicle. And we were just overwhelmed by the reception because there are not a lot of people taking a true private equity approach to minority stake investing. Most business owners, when they think about selling a stake in their company, but not all of it, they'll go to a lender or they'll go to some like structured equity firm and they'll give them a term sheet that candidly gives me a headache to read. And I have a fancy MBA and I just say this doesn't make sense. So we took a very simple and transparent approach to taking non-controlled stakes.
As the CEO of a business, what would be the biggest difference I would notice if I did a deal with Trivest with the core fund or with the non-control fund? What would the biggest difference be in support that I would get? What would the biggest difference be in, TPS reports I have to fill out? All that.
Right. My answer is zero, zilch, nada. Right. There is zero difference. between the
Support me
steps that we go to build value.
whether you own 35%
Yeah,
or
Todd, I would put it like this, Todd. Let's say you're familiar with our investment returns, which have been, sort of top decile, and you said, I'm going to give you $1 million of my savings, and I'd like you to put 500,000 in your control fund and $500,000 in your non-control fund, right? And you give me the money, and over the next 5 years, I invest that $1 million in 15 companies, let's say, right? And 5 years later, once we start exiting those investments, do you care what percent of a company we own that we use your $1 million for? No, you don't care. You're going to come to me and say, Jamie, I gave you $1 million. You're going to give me back $2 million? You're going to give me back $3 million? Or you're going to give me back 400,000? So our investors, they don't care, and that's our customer, and we are judged on the investment return we generate for them. And so that's the mindset, because sometimes the business owners doing a transaction with our growth fund say, how do I know you're not going to be like my brother-in-law who's an idiot that put $50,000 in my company when I started it, and now he owns 20 or 30%. He does nothing except get distribution. And they say, I don't want you to be a passive investor. And I say, if I'm a passive investor and if I don't bring the Tribest heat and all of our weaponry to the table, I'm not going to generate decent returns to keep Tribest engine going. So once the only difference between a control deal and a non-control deal, Todd, is in a non-control deal, it's a straight equity investment. We are not putting debt on your company when we're buying the 20 or 30% stake. In our control fund, there is third-party financing that gets combined with equity from our funds to hand you the, quote, purchase price for your business.
Got it. So, and I'm keeping my eye on the clock for us, and I could go, I've got another hour's worth of questions, and I know you're already being generous with your time, but you guys also have a secret sauce. I think you call it your path to 3X. So
Right.
Just as a general rule, when you come into a company, let's call it somewhere between $1 million and 10 million of EBITDA, what are the components of that path to 3X that almost always start to show results for a CEO?
So we have a group called the Portfolio Support Group, and these are operations folks. They don't have to go find a transaction. They don't work on the due diligence. Once the money goes in, they are a resource. And part of their responsibility is to install the Path to 3X initiative. There are 6 initiatives. One is the category of one statement we talked about earlier, which is what makes you unique. The second one is helping you top grade your management team, right? Do you have the right people in the right seats? And as the company grows and scales, help with just building out management teams. We're not coming in there looking to have a big reduction in force. The days of RJR Nabisco, that was 20, 30 years ago. We have to grow the business. But to grow the business, it's filling the holes that might be preventing the company from accelerating the growth. Performance management, right, which is all of the organic growth strategies that we can work on together. Add-on acquisition. So we want to become your outsourced M&A arm. And really just the last one is the value creation checklist. Stated simply, we know what the other side looks like. The other side is when you have a business optimized, and whether that owner, their second bite is 20% or it's 60%, right? We know what the bigger private equity firms and the strategic buyers want to see that, quote, checks all the boxes. And so during our time with the company, which is typically 5 years, that's what the Path to 3X is doing. It's getting the business positioned for a premium valuation at the next transaction. And what's a premium valuation? It's when you get private equity firm and strategic buyers acting irrationally because it's a must-own asset. And it's hard work. This is not something that an investment banker is going to be able to do in the 1 or 2 months prior to, quote, taking you to market. This this is a multi-year program, and every quarter we score adoption on the path to 3x. And we have this unbelievable chart that shows the more you buy into the path to 3x, the higher the multiple of invested capital, meaning the success on the transaction. And prior to putting in the path to 3x methodology a dozen years ago, about a quarter of our businesses were tripling in value in a 5-year period of time. After putting in the path to 3x methodology, 87% of companies have tripled their value, which is just a jaw-dropping statistic, right? And so that I say facts are stubborn things, right? This stuff works. And now when business owners are doing reference calls with other Tribest founders that have been through the gauntlet with us, that's what they're talking about. Listen to this path to 3x. This stuff works. It had a dramatic impact on my second bite of the apple.
And to be fair, that installation of that is a full-time job in and of itself. That probably, since the CEO has a full-time job, right, without experience on the path to 3x, that's just right. One of the several areas where.
Yeah, I tell business owners, I think there's a little bit of confusion sometimes of these guys are going to, quote, drive me crazy. We don't take office space at the company. We're not making hiring and firing decisions. We're not getting in the minutia. We don't want the production manager calling to complain about their bonus. We are interacting. We Trivest, we interact with the CEO and the CFO typically only. But the path to 3x is being installed by the Trivest deal team that, quote, did the transaction with portfolio support and business development, because a big chunk of the path to 3x is becoming the outsourced M&A arm for our companies. And so it's those three elements of our business working together in a non-disruptive fashion so that the business owner can focus on the day-to-day business. This is not something that is like suddenly 30% of the CEO's time has to be carved out for this stuff. We are working on this on the side. We're not on the playing field with the business owner. We're on the sidelines, if you will.
That's great. So 2 last questions, and I'll bring us in on time. One question I always ask past clients of mine and people I interview is, there's a lot talked about regarding the second bite, whether it's an earnout or an equity roll forward. And what did you learn from your experience? And that's one data point that person will share. And it's very enlightening. Now I'm talking to a guy who's done it literally hundreds of times.
Right.
Is there a key ingredient beyond the buy-in to whatever the plan is that you would attribute a lot of the success to when people have really rung the bell on a second bite?
Yeah, I always encourage business owners, and I'm shocked that it doesn't happen more, but the business owner should be interviewing the private equity firm as much as the private equity firm is, quote, interviewing the business, right? Because this is a marriage, like it or not. You are bringing on a financial partner. And so I would recommend extensive referencing. I would recommend that the business owner goes on the company's website and sees how active the firm is. I would tell you to be careful of firms that aren't very active. That means they just have an orientation of figuring out a reason not to do a transaction. I could give you the case, and no offense if any of our 38 business owners are listening, I could give you the case why we should not have done all 38 companies in our portfolio. There is no perfect company. There is no oh my God, there's nothing wrong or there's nothing to do with this business. And so, we're a firm that kind of leans in, but it's really having a real business relationship. If you think this is just about money and I gotta if a business owner is so short-sighted as to, well, I'm going to pick this other firm because they're going to pay me $1 million or $2 million more for my company, even though that other firm I feel like I have a better rapport with, I would suggest going with the firm that may not be the apps. They obviously have to be in the same zip code valuation, but if you can double or triple or quadruple the value of the quote second bite of the apple, those dollars are very, very significant. So it's taking the long game, if you will, with a business owner and making a really informed decision. Because I see a lot of business owners that just, it's just about this first transaction and they almost write off the second bite of the apple. If you're dealing with a sophisticated, successful private equity firm, they have a demonstrated ability over a long period of time to really grow the value of the company. So really pay attention to your second bite of the apple is my point.
That's a great insight. In these, I know you got a bunch on your shelf, the deal trophies behind me. All of our clients have had success in their second bite. And if there's one reason for that, you guys match up really well with a lot, but not with everybody, obviously, right? And vice versa for other firms that are out there. I get a lot. For example, when we're doing a call, my client, the CEO, will say, well, so what's Jamie going to want to hear? What should I tell him? And my answer is always the same. He wants to hear the truth. If it doesn't fit, if he doesn't like it, if he's not a match for you or you for him, I'll find you somebody that is a perfect match. The reason people get in trouble post-close is because I kind of hedge the truth a little bit to Jamie. I lost a bunch of weight for the wedding and this is who I really am, whatever the analogy is. So I think that's really great advice. I think it's part of the value add that we try to bring. I'm a huge fan of Tribest for all the reasons we've talked about in the last 40 minutes. But Tribest isn't the right fit for everybody because some people have spent a lifetime building a business. They want the extra $2 million now. So be it, right? So last question.
Yeah, and I would say the other thing in terms of the advice that I give a business owner, when you're initially talking to a private equity firm, remember the private equity firm is trying to think about it as a lightning round, right? Sometimes business owners will spend 10 minutes on one answer where they could have done it in a minute or two. And so we're trying to get a big picture feel for the business. And we really want to hear from the business owner is what do you think the opportunity is over the next 3 to 5 years? What have you put in place? What seeds have you planted in the past 2 or 3 years that might sprout and be the other leg to the stool? And so the number one determinant of your company's valuation is my expectation of your future growth. And a lot of business owners, they think it's as simple as my EBITDA times some number and what's my multiplier. And candidly, that's the dumb money. It is true. Once we're done with our work, you can take the quote purchase price and divide it by your EBITDA and come up with a multiple. But that's really not the way smart money does it. We are evaluating a myriad of factors, customer concentration, cash flow conversion, the industry, on and on and on. And we're trying to project out your company's cash flow over the next 5 years. And then we're triangulating an acceptable return for our investors by plugging in a series of valuations. And so it's really thinking about not just the business owner and what they've done in the last 5 years, but help me dream big. What is the vision for the next 5 years? And the more excited I get, the happier you're going to be with the value in the letter of intent.
That's super. That's a great place to end our time since we're running a little bit over. So a couple of cleanup things. Trivest.com/second bite. Ryan has set up information there so that you can communicate directly with the people with Ryan and Tony directly at Trivest. There's some additional information on Trivest and on from there. And then if you prefer, you can obviously reach out through Potomac Business Capital. You can find Jamie on LinkedIn, although Jamie's not a big LinkedIn person. Todd is, so you can reach out to me there. But Jamie, I know you've got 100 people pulling at you, 25 hours a day. The fact that you carved out an hour for us today has been super generous and very enlightening. So I'll say thanks a bunch for your time.
Thank you very much, Todd. And I really enjoyed the conversation.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.